Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Good afternoon, ladies and gentlemen. Welcome to this very special show, actually the budget special in our Market Masters series, the first show that we bring to you ahead of the interim budget 3 sessions from now. Our guest is a special person today, Mr. Saurabh Mukherjea, a man of intense control as far as both India's fiscal balance sheet and stock picking is concerned. And with me is also Sakshi Batra. Both of us over the next 20-25 minutes, 30 minutes engage Saurabh in a conversation that takes us from the macro picture of India as far as the balance sheet is concerned, ahead of the budget, and of course quality stock picking. Good afternoon, Saurabh, and a very warm welcome to you. This is our first episode as far as the budget special is concerned. Let's start with the macro picture as far as India is concerned. A very strong fiscal balance sheet welcomes us, as also the interim budget 2 or 3 sessions later. Good tax inflows and much in control as far as the twin deficits are concerned. How do you see this?
I think this is actually a very, very rare situation, and it's a very interesting situation. We are at the top of the interest rate cycle. We're at the top of the interest rate cycle, both for India and for the United States. And in spite of that, the currency is strong, as you're alluding to, Shell. The current account deficit is actually below 1.5%, which is quite remarkable, given that the U.S. Central Bank has hiked rates by 5.5% in the last couple of years. And the RBI has only hiked rates by 2%. The fact that the currency is held strong, the fact that the current account deficit is 1.5%, I think that bodes well for India's fiscal for India's macroeconomic strength. Now let's come to the fiscal side. The budget deficit, I think the government will probably say for the year to March 24, the government will say, given that tax collections have risen at 14-15%, I think the government will probably come in with a budget deficit around 5.9. But I think the more interesting figure will be the announcement for the FY25 target. And
Yes.
my reckoning there is, given that this is going to be India's first year as part of the JP Morgan Emerging Market Bond Index, this is India's entry into the global bond market, I think the government will want to put up a strong showing. And one simple way to put up a strong showing in the global bond market will be for the government to target a budget deficit close to, say, 5.2%. So if the government can say 5.9, we've done in FY24, and tell the world we'll aim for something like 5.2 for FY25, I think we'll see very strong inflows into the Indian bond market. The Indian 10-year bond yield will come off. At the overall consolidated center plus states debt equity level, India is pushing 80%. That's not a particularly worrying figure, but neither is that a low figure. So my hope, my prayer is that the FM announces an FY25 budget deficit target closer to that 5.2 number, so that our first year in the emerging market bond index is a happy year, and the government of India bonds become a highly recognized asset in the global bond market.
Right. So this is the macro picture that Saurabh has painted for us ahead of the February 1st budget. Saurabh, it's common knowledge that in the election year, this one is going to be an interim budget. Nevertheless, is there a possibility that Finance Minister Srimati Nirmala Sitharaman might pull out a rabbit from her hat and maybe come up with some changes that might impact markets positively? What are your hopes and expectations from this document?
So look, the FM has tried to control all our expectations. He said that don't expect dhoom dhadaka in the budget. But that being said, I'll be astonished if the government and if the FM didn't take this opportunity, didn't take 1st February as an opportunity to set up basically the economic manifesto. And if I was in her shoes, looking back at the last 3 4 years, especially looking back at the post-COVID response, I would set the budget up around three broad headings. I think the first area is the government social welfare schemes have been actually very successful post-COVID, and in that, if I think about social welfare schemes, immediately think about PM Awas Yojana. Wherever I go in the country, I hear low-income people have benefited enormously from the PM Awas Yojana. So I'd expect to hear a step up in PM Awas Yojana. I'd also expect to hear about the health insurance program, Ayushman Bharat, or the health insurance program the government has put in place. I think it's health cover of 5 lakh per family. I think that will also be stepped up. That's been a very popular program. And thirdly, PM Kisan. This is an election year. It'll be strange if the government didn't focus on the farmer. And PM Kisan, under which I think farmers get roughly 6,000 rupees a year, and expect to hear that stepped up a bit. So that'll be the first sort of area. We remember the government's already stepped up extended food guarantees, food security guarantees. That's already in the price, so to speak. But the other social welfare programs, if I were in the FM shoes, I would draw attention to them and step it up going forward. The second is capex. The capex has been the signal success of NDA too. I think capex on railways, defense, and roads has doubled in the last 3 years cumulatively. I'm not so sure there's going to be enough fiscal space to increase capex by another 30%. I reckon overall capex growth will be around 10 to 15%. But given the defense challenges the nation faces, I think defense will be a big area of focus. China is not going to be a country that will keep quiet. So capex has been a big success. I'm sure the FM will highlight their success in capex and then step it up on and defense capex. And the third is middle class. Programs aimed at the middle class. The FM has consistently increased the standard deductible for income tax. I'm sure we'll see another hike in the standard deductible for income tax. And then as an investor, I'm hoping there'll be announcements of some degree of tax relief for investors. India doesn't have anything like the 401k program. I think we need something along the lines of 401k, where those watching this program can save and invest without incurring tax. And then when you withdraw the money for spending in your post-retirement years, that's when you end up paying tax, right? So NPS is somewhat similar, but NPS doesn't have all the tax benefits that we need. Plus, NPS has this fee ceiling of 10 bips. So if we can get something for the middle class, which encourages tax-free saving and investment, and then when you retire and you spend the money, you pay the tax, then that'll be brilliant.
Okay, so those are the big expectations from the upcoming union budget, interim budget. We also have a lot of questions coming in from our viewers, Saurabh. So I'll take a few of them during the course of our conversation. The first one is related to the budget, and Vihan Sharma from Bengaluru asks you, where exactly should I invest ahead of the interim budget? You mentioned 2 or 3 themes, but do you think spaces like defense, which have already had a great run-up, still have a potential for fresh investments?
My first sort of way of responding to this will be never make investments solely on the back of the budget, right? The excitement or whatever it is that follows the budget seldom lasts more than 24 hours. So make investments thinking more generally about the health of the economy and focus on investing in companies that are anyway doing well, just that the budget is a further fillip to them. And in that context, I would point Vihan to the building materials industry.
Okay.
As it is because of the success of PMAY, building the construction sector, the home construction sector is doing well. And for us in Marcellus, we've invested in companies such as Asian Paints and Pidilite for many years. More recently, over the last 6 months, we also built a position in Serra Sanitary Ware. And also in a company called Everest Industries. Serra Sanitary Ware makes sanitary ware. It's number 2 in the country after Hindustan Sanitary Ware. And Everest Industries is the largest manufacturer of cement fiber boards, right? So these are the basically partitions of such as the room I am sitting in, partitions of hotel rooms. Cement fiber boards is higher quality than plywood or gypsum. But the installed base in India is a few thousand crores, around 20,000 crores. We think the cement fiber boards industry is going to get much bigger in the years to come, and therefore Everest Industries is the company we have built a position in. So there's plenty to invest in building material. It's a big sector. Choose your spots in that, Vihan. My reckoning is the government will continue encouraging individual ownership, home ownership, especially for low-income people. And with that in mind, we've invested in a company like Serra Sanitary Ware, which creates affordable sanitary ware for home construction projects.
Okay. Saurabh, now let's look at the broader markets. We've had a Goldilocks kind of a scenario over the last 6 months. January, even though being volatile, hasn't caused much pain apart from the fluctuations that we see on a regular basis. How do you see the markets from now on? Where do you see pain points coming in? And what, according to you, is still evenly priced?
So let me start with the pain points. I think the area of the market which has, I think, bewildered many of us, right, is the mad rally in small caps. It really is an insane rally, up 150% in what, 3 years, up 50% in the last 12 months. And a lot of this rally, hasn't had quite earnings support. And earnings compounding for small caps has been decent, around 20-25%, but hardly anything to warrant the 150% run up that we have seen in 3 years. And specifically within small caps, you can see that low liquidity stocks with questionable governance, questionable accounting have done particularly well. That I would say is the main area of concern in the Indian stock market for us. Even we ourselves have been very cautious with our small cap investments. It's been very tempting to join the small cap party and load up on low quality stocks, but we've tried our best to resist that temptation. In terms of areas of value, I think that the straightforward area of value I would point your viewers towards is look at large banks, private sector banks, look at large IT stocks, look at large FMCG companies. None of these sectors have had a good run over the last 3 years. The market has chosen to go towards low PE stocks. And say if you look at a bank like HDFC Bank, earnings compounding for the last 3 years, 5 years, 10 years, 20 years has been around 20-25%. And yet HDFC Bank is trading at its, I think, 20-year lows on price to book and 20-year lows on PE multiples. Similarly, I think I'm using HDFC Bank to make a point. Similarly, a Kotak Bank also hasn't gone anywhere. And if you take the IT services sector, names like TCS, Infosys, they've also not gone anywhere in the last 3 years, in spite of the fact that their order books are at all-time highs. And it's relatively clear that the Western world will have to come to TCS for AI, for cloud, and the entire migration away from legacy computing to new generation computing. So huge pockets of value in large caps, quality large caps such as a TCS, HDFC Bank, or a Kotak Bank. And my reading is if the rate cycle in America turns south, if the Federal Reserve starts cutting, this is where the foreign money will pour in. A quick disclaimer here: all of these stocks that I'm mentioning, I'm invested in all of these through Marcellus's PMS. So are my parents, and so are our 9,000 clients.
So, Saurabh, would you say that the current levels of HDFC Bank, you would look at them as mouth-watering levels to enter into, even despite having not performed in the last 3 years? We actually saw the recent dips also not getting any big takers for HDFC Bank. But would you say that this is the right time to start investing in HDFC Bank now?
Look, I'm no expert in market timing. So for our part, we've been invested in HDFC Bank for a long time. 6 months ago, we increased the position. Actually, it's now it's around 10% of our portfolio. We increased the position 6 months ago because the valuation looked so mouthwatering. And even in the recent last 2 weeks of panic, we've been very positively inclined towards HDFC Bank because I don't see any underlying challenge. Yes, there could be a couple of quarters in which their deposit intake could be a little lower than what the market's expecting. But we got to keep it in context. This bank has acquired more market share on both sides of the balance sheet than any other private sector bank, not only in the history of Indian banking, but even in the last 6 months. Even in the last 6 months, on both sides of the balance sheet, HDFC Bank is pulling away more market share than any other private or public sector bank in India. And the same applies over the last 5 years or 10 years. So you're seeing a growth machine with no equal in Indian banking. And the fact that you can get it at these 20-year lows on multiples, I think is a great opportunity. We are certainly availing of it to as much an extent as we can in our portfolio management services construct.
Okay. Just a line on HDFC Bank. down about 15% in the month of Jan. This is the worst performing Nifty and Bank Nifty stock, be that as it may. One thing is for certain, good prices and good times don't come together in markets, and HDFC Bank perhaps represents one of the finest corporate balance sheets that we have seen over the last 35 years. Interestingly, I was just checking some data, Saurabh. If you look at the 10-year price to book median for HDFC Bank, it's the average is 4, and at the moment it's trading at 2.5. So that itself shows how the markets are valuing the bank. But let's see how this pain fades out over a period of time. Saurabh, let's pay attention to another universe, and that's pharma. Some of the money that has moved away from maybe stocks that we've just discussed, or the profit booking that we've seen over the last month or so, has moved into pharma, and front lines are doing pretty well. In your own portfolio of 39 stocks spread over 10,000 crore rupees, are there any pharma picks that look enticingly valuable at this point of time?
I'll leave aside specialty chemicals. I'll focus on making of pharmaceuticals per se. So we've never invested in the conventional Indian pharma stocks because we believe the business models are quite weak, right? So making dawai in India, then going off to America, selling it at huge discounts to what a Glaxo or a Pfizer or a Merck can sell it. I've never understood why that's such an attractive business model. And if you look at the return on capital employed of the big Indian pharma companies who follow this business model, where they make it cheap in India and they sell it cheap in America, it's not a particularly lucrative business model. The one business model in Indian pharma which we like and we invested heavily 5 years ago is called Divi's Lab. So Divi's makes APIs. It's the fifth largest active pharmaceutical ingredient maker in the world. It's the largest in India. So, for example, 3 out of 4 painkillers, 75% of the world's painkillers, the APIs come from Divi's. So we invested in 5 years ago. The stock had a rocket propelled run through COVID. We actually pulled the position size back when the stock made a lot of money for us in COVID. Jan 22, the company said that COVID is done. We won't be making molnupiravir for many more months. The stock halved between Jan 22 and Jan 23. Last year, this time, Shell, exactly a year ago, we quadrupled our position in Divi's Lab, and therefore it's become a big position for us. The stock has done well in the last 12 months because of the fact that America and China are at each other's throats. China makes 90% of the world's API. India makes only 10%. And as the American pharma companies swing their pharma procurement away from China and slowly towards India, Divi should be a big beneficiary. So we quadrupled the position in exactly a year ago, and then we saw the stock rally over the last 12 months as they've announced their third factory in 30 years. And in that third factory, this is in Kakinada in AP. In that third factory, they've said they're going to make contrast media. This is the stuff which you drink before an MRI scan. So China dominates contrast media, but the Western pharma majors are swinging their procurement away from China towards India, and we see Divi's as a big beneficiary of this trend.
Okay. Let's take another question from our viewers. This question is from Surendra Seth from Indore, and he wants to know from you, should I continue to invest in PSU stocks after the stellar 2023 run that we have seen? And if I could extend that part a bit and ask you that, how are you looking at the PSU story now unfold? We've seen big bang rally unfold in various PSU stocks, be it in defense, be it in railways, be it in power, be it in PSU banks. And where do we go from here?
Sure. So I think Surendra is absolutely right. PSU stock share prices have done enormously well in the last couple of years. We've not had any of them. The main reason we don't invest in PSU stocks, Surendra, is the PSUs are owned by the government of India, and their duty is to serve the country rather than the shareholder. So say if I was a shareholder in a PSU, the PSU really shouldn't be caring about Saurabh Mukherjea, the shareholder, because the PSU's main concern should be looking after the government's interests. So say if you're a defense PSU, you're effectively part of the armed forces ecosystem. Your job is to produce weapons which benefit the country at prices which benefit the country rather than trying to show a return on capital and shareholder returns for investors like me. So whether it is a PSU which is generating power, or a PSU making guns or aircrafts, or doing power transmission, a PSU job is to serve the interests of the nation rather than the interest of shareholders. And we believe the two are divergent, and hence we've stayed away from PSUs.
Okay. Saurabh, let's look at the other parts of the market, which is the IPO part. We've seen a fantastic rally in lots of stocks in this particular space in 2023. Are there any IPOs that you are personally looking forward to in Marcellus for 2024? And how has been your stock picking in that space?
So we have historically, by and large, had stayed away from IPOs. I think the closest we've invested in an IPO was 6 or 7 years ago, 6 years ago, 7 years ago. I think it was Dr. Lal Path Labs. And the reason we largely stay away from IPOs is when a company goes public, right, they typically don't give you more than 3, 4 years of history. And 3, 4 years of history say you don't really know much about the company. So we try to build, at least even in a small cap company, we try to build a picture of at least 5, 6 years before we make the plunge. So the closest we got to investing in IPO substantially, that was 6 or 7 years ago, was Dr. Lal Path Labs. More recently, 2 years ago, yeah, 2 years ago, took a small position in Tarsans, couple of months after the IPO. This is a Kolkata-based company which makes lab consumables. We're still invested in Tarsans. We haven't been able to make too much money here. But Tarsans is a company that sort of fits our construct. This company supplies pipettes, beakers, carboys to, say, firms like Dr. Lal Path Labs. They'll be supplying the chemistry R&D lab in, say, a Cipla or a Dr. Reddy's. So Tarsans is the leading Indian producer of lab consumables, as it's called. Operating margins are around the 40% mark. And as a result, return on capital tends to be healthy. More recently, 3 weeks ago, they announced an acquisition in Germany, where they've acquired a company that makes lab consumables in Germany. Tarsans' goal will be to take that business, take that acquired company, use the customer connect of that acquired business in Germany, and go and sell lab consumables from India to the Western world, to European pharmaceutical companies, to European chemical companies. The world leaders in this are giant companies. One is called Becton Dickinson, and the other is called Thermo Fisher. These are all $20-30 billion market cap companies. So Tarsans is the leading producer in India. It's one of the most efficient producers in the world, and we believed that there's a huge headroom as Western companies come to India and try to find pipettes and beakers and carboys at cost-efficient rates at high quality. So we hope that this Kolkata-based company will produce joy for us in the years to come. But that apart, Shell, we've stayed away from the IPO market. I'm looking forward to, with the way we use the IPO market, we use it to learn about what's happening in the country. So I'm quite interested to see what First Cry has to say. First Cry is a company which sells products aimed at infants online. So it's very interesting. IPO, we think the whole theme around women and child and women spending will be a big theme in India. So it'll be interesting to see the First Cry DRHP.
Okay. Just a small note on Tarsans. The price band for the IPO was 635 to 662 rupees. And at the moment, it's available below its IPO price. So maybe there is value to be had at the moment. Saurabh, let's get to brass tacks. What are the 3 or 4 stocks in any kind of market capitalization zone that Marcellus has added over the last 2 months? And what are the reasons thereof?
Sure. So I've mentioned Everest Industries already. So Everest Industries, I mentioned the cement fiber board piece. So cement fiber board is a nascent industry, but it's growing fast. It's a better product than gypsum or plywood. And given that the hotel industry is booming in our country, residential construction, office construction is booming, we think CFBs have a long future ahead of them. There are other players in CFB. So Ramco Cements makes CFB, Vishaka Industries makes CFB. But in a country of our size, there's only 4 large CFB players, and it's a high margin product where we think there's plenty of headroom to grow. Alongside CFB, Everest Industries is also the largest listed manufacturer of prefabricated engineered buildings. So these are basically buildings where You, in the space of 9 or 10 months, you put up a 10-story hotel or a 10-story office building through prefabricated steel girders, which go into the ground in the space of a few weeks. And clients of Everest Industries are people like Flipkart, Tata's Defense Wing, hotel chains in our country, the Adani Empire, and so on. So we felt that both of these businesses, CFBs and prefabricated engineering constructs, will do well as the capex cycle continues to pick up steam in India. And this was a position that we built up over the last couple of months. Similarly, staying with the capex cycle, we believe the industrial capex cycle, the private sector industrial capex cycle hasn't yet picked up. We think it's overdue. Government capex has been strong, but private sector capex hasn't yet picked up. We believe it's overdue, and to benefit from that, we built firstly a position in a company called SKF. So SKF makes industrial bearings. It's the leader in industrial bearings. It's an MNC company. The stock hasn't done much over the last couple of years because the private sector capex cycle hasn't yet taken off. But given that this is the market leader, it's a profitable company, it's been dominant for 40, 50 years in industrial bearings, we think it's a simple way to play the bearings pickup. And similarly, Shanti Gears. So the gear market in India, the largest player is a Gujarat-based company. Shanti Gears is part of the Murugappa group. It's the most profitable of the gear manufacturers. It's in South India and Coimbatore. That's where the big capex action in India we think will take place. And therefore, Everest Industries, SKF, and Shanti Gears. These are the three investments we made over the last 2 to 3 months as we get ready for the private sector capex pickup on the other side of the elections.
Okay. Everest Industries, SKF and Shanti Gears, and we will continue to keep an eye out on all of these stocks going forward as well. The next question I'll take from our viewers list is from New Delhi. Alok Verma wants to know from you, we were talking about the IPO space, he wants to know which are the new age tech stocks that look fairly valued now and can be invested in.
So Alok, I mean, we've got a long-standing investment in InfoEdge, and as you probably know, InfoEdge is a shareholder in Zomato. So you could indirectly say through the good offices of Sanjeev Bikhchandani and Hitesh Oberoi and InfoEdge, we've got exposure to Zomato. But barring that, we haven't really we haven't really fallen in love with the new age tech stocks, mainly because the business models don't appear to us to be particularly strong. What do I mean by that? When I look at a business, I try to figure out, does this company make money at the specific customer level, right? So this is called unit economics. So on an individual customer level, does this business make money? And a lot of the new age businesses fall flat on that. So you can deliver as much pizza or vegetables to me as you want, but if you don't make money on delivering pizza to me, then it's going to be very difficult for you to build a viable business. So on that unit economics basis, many of the new age businesses unfortunately haven't passed muster at Marcellus, and therefore the valuation piece is a little secondary. The closest a business comes to having good unit economics, I think, is Nykaa, FSN e-commerce, I think they're called. About Nykaa, which came off, it looked interesting, but then they started taking whatever little money they make on beauty and personal products, and they started putting that in the clothes space where they're going head with Myntra. So that didn't give us any comfort. It's difficult enough to win one space, dominate, build moats, make a lot of money. But if you then start plowing money into an equally competitive space, which is online apparel, then it becomes hard for us to understand when will the business turn free cash flow positive. So I thought Falguni Nair and team have done an excellent job in building Nykaa. A little perplexed as to why they are taking their hard-won cash flow in beauty and personal care and going into an adjacent vertical in an apparel.
Okay. The last question from our viewers is from New Delhi again. Prachi wants to know, what are your thoughts on the insurance sector stocks, and is it a long-term sector to bet on?
So look, I think I'll focus on general insurance. Life insurance is a different world. It's a more complicated sector to discuss. So on general insurance, again, break it up into two parts. Let's break it up into motor. Motor is heavily regulated. So the rate at which, Prachi, you will buy third-party cover. Third-party cover is mandatory. You can't drive a car or a bike in India without third-party cover. But the TP rates are set by the regulator, and the regulator, in their infinite kindness, lets the insurer make a little bit of money on third-party cover. So the competitive area of motor insurance, therefore, is own damage cover. right? Own damage cover is the comparative area, and we've long held the view that the most clever underwriter, the most discerning underwriter is ICICI Lombard when it comes to motor insurance. That's been over the last 20 years. The data is very clear. ILOM has been the best motor underwriter in India. So roughly half of ILOM's profits come from motor. Then the rest of the general insurance sector is a mixture of health. So group health covers for say companies like the Aaj Tak India Today family, or for companies like Marcellus. Again, in group health cover, ICICI Lombard leads. As you can imagine, in the wake of COVID, every company now wants to offer group health to their employees, and ILOM is a beneficiary of this whole move towards group health cover. There's also individual cover where if a company doesn't insure you, you can go and buy yourself an individual cover. That's a smaller market, but it's growing fast. There, the market leader would be Star Health. It's a company we haven't invested in, but in individual cover, I think Star Health will be the market leader. And then the final bit of general insurance, which is very interesting, is what's called marine and fire. So, these are large companies, say Reliance protecting its factories from accidents, fire accidents or floods. Basically, large industrial setups buying big ticket marine and fire cover. There too, our reading is ILOM is the best underwriter. The reason this bit is really hard to do is you typically have to reinsure with a global insurer like a Munich Re or a Swiss Re, because you can't sort of take that sort of protection for a Reliance Industries and keep it on your balance sheet. So you sell protection to Reliance and then you reinsure back to back with the global leader. The global leaders don't like doing business with many of the Indian general insurers. ILOM is an exception. ILOM is very highly regarded by the global reinsurers, and therefore here too, marine and fire, ILOM is the most profitable of the lot. So if you put it together, general insurance, attractive sector, lots of growth to come as the economy booms, as you and I look for cover on health and we look for motor cover. And ILOM, we reckon, is the best placed of the general insurers in our country, and it's a significant part of our portfolio.
Okay. 1 year performance of ICICI Lombard has been a 31% uptick on the stock price. Time's running out, Saurabh, and a final question from our end. A large part of the third quarter earnings have been reflected in stock prices. Any outperformers that catch your fancy over the next 6 months because of these earnings, and any disappointments that you might have had?
Well, look, from our side, we're quite pleased with the fact that the IT services companies, we have a large position in TCS. We also own a couple of engineering R&D companies such as LTTS and Tata Elxsi. We're quite pleased that these companies are highlighting what looks like a turnaround in IT services demand in the Western world. The Western economies seem to have troughed out as the interest rate cuts begin in the Western world. We're hoping that our investment in TCS will bear fruit. We've already made a decent amount of money on LTTS and Tata Elxsi, wouldn't mind making some more. But TCS has been tough going for us, and we're quite pleased that the IT services companies are almost uniformly guiding towards more business this year for them. The area which remains a challenge for us is specialty chemicals. We've had large investments there, companies like GMM Pfaudler, Alkyl Amines, Clean Science. These have been large investments of ours. China has been brutal in terms of dumping chemicals around the world, including in India in 2023. Hopefully, the Chinese have throttled off on dumping. The India's import data suggests a degree of abatement in Chinese dumping over the last couple of months. I hope and pray that continues through 2024. Otherwise, it'll be very difficult for us to make money in specialty chemicals.
Okay. With that, ladies and gentlemen, this special edition of Market Masters ahead of the interim budget draws to a close. Thank you, Saurabh, for such a wonderful opportunity.
Thank you.
And I hope 2024 works out better than 2023. Thank you so much for your time, sir.
Thank you.
Thank you so much. Thanks.
Okay. This, ladies and gentlemen, was a conversation ahead of the interim budget, which will be live on February 1st, as also on Business Today. Do join us when that event actually occurs. We've had a wonderful rally ahead of the budget over the last 6-8 months, actually from April till about early January. And the markets are perfectly poised ahead of the budget. Let's see what all comes as far as that document is concerned. But for the moment, thank you from both Sakshi and I and our PCR team.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
Celebrate 32 years of leadership in business news with Business Today. From the groundbreaking AI cover of Sundar Pichai to PM Modi's exclusive on G20, we redefine headlines. Now our 32nd anniversary issue explores India 2029, the 5-year agenda, with industry titans sharing exclusive insights. So, just BT it for unparalleled perspectives. Business Today, 32 years of leadership, innovation, and business brilliance. Subscribe now. In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-risking the Future in collaboration with Business Today.